Welcome to our lecture on journalizing. The recording of transactions we discussed previously using the accounting equation and the matrix becomes unrealistic when we add accounts and try to track transactions over a longer period of time. Luckily, there's a more efficient alternative to recording transactions. This lecture will introduce 3 tools to make the recording of transactions and the tracking of account balances more efficient. The first tool is a journal. Here we see a sample general journal. Note the 5 columns. The first column is for recording the date of the transaction. The second column is where the account names are recorded for the accounts involved in the transaction. The third column is for a posting reference that we will discuss in a future lecture. The fourth column is labeled the debit column, and the fifth column is the credit column. We will define debits and credits in a couple of slides. For now, we just want to get the visual concept of what a journal looks like. Here we see a sample journal with transactions that have already been entered into the columns. We'll discuss how to enter transactions into a journal in just a few slides. The next tool we need to introduce is called a T account. A T account is used to show increases and decreases in an account. One side of the T account represents an increase, and the other side represents a decrease. Which side represents the increase depends on the type of account it is. The total increases and total decreases are netted out to determine the account balance. This T account represents a cash account, but we could produce a T account for any account that we want to track. The T account is a tool used by accountants just for this purpose. The third tool is really not a tool at all, but rather a fundamental accounting concept. We will now discuss debits and credits. When it comes to debits and credits, the only sure thing is that debits are always on the left and credits are always on the right. This holds true for journal entries. Remember the journal we saw earlier? The debit column was the fourth column, the left column, and the credit column was the fifth column, the right column. This also holds true for T accounts. Debits are recorded on the left side of the T, and credits are recorded on the right side of the T. Some accounts are increased with debit entries, and some accounts are increased with credit entries. The entry that increases an account is also known as the normal balance. If an account is increased with a debit, it's decreased with a credit, and conversely, if an account is increased with a credit, then a debit will cause that account to be decreased. We have discussed in the past that there are 6 different categories of accounts that affect the accounting equation, and here on this slide we see those 6 categories listed once again. Half of the accounts are increased with debits and half are increased with credits. Here we see with a T account representing that the left side, the debit side, accounts are increased with debits are assets, expenses, and drawing accounts are all increased with a debit entry. Liabilities, revenue, and capital accounts are all increased with a credit entry. If an account is increased with a debit, then it's decreased with a credit. And if the account is increased with a credit, then it'll be decreased with a debit. I have a little jingle to help us remember which accounts are increased with debits and which accounts are increased with credits. The jingle goes like this: after eating dinner, let's read the comics. The first letter in the words to the jingle relate to the first letters in the account categories. Now I realize this jingle's a little dated. It's probably been the 1950s since kids actually read comics, but you can make up your own if you're more comfortable with that. Remember, the jingle tells us the category of account and which entry causes the account category to increase. Now that we have the tools, let's learn how to journalize a transaction. Many of the same rules apply to journalizing that we discussed in recording transactions in Module 1. Every transaction affects at least 2 accounts. The debits and credits rules will keep the accounting equation in balance. Every transaction must have at least 1 debit and at least 1 credit. For each transaction, the debit entry dollar amount must be equal to the credit entry dollar amount. We will use the following transaction to demonstrate a journal entry. On February 8, 2008, the business received $500 cash for services performed. To record a transaction in a journal, we first enter the date. We note here that the date, the year has already been entered at the top of the journal. That's a typical practice. This is the first entry on this journal page, so we put the month and the date here, February 8th. From here on out, in February, when we enter a transaction, we won't even have to record February. We'll just put the day that the transaction occurred. So if we had a transaction the next day, we would just enter a 9 in the appropriate box. The next thing to do is to go over and choose the debit entry account. In this case, cash, and we're going to learn why it's cash in just a moment, but we just want to demonstrate the recording of a journal entry right now. Notice that the debit entry is on top, and it is indented against the margin on the left-hand side, and all we enter is the name of the account that's being debited here. We skip over the posting reference column. That'll be used later, and we'll discuss what it's used for in the next lecture. And we move over to the debit column, where we enter the amount that the transaction was for. In this case, $500. We've received $500 cash for services performed. The next step is to go down to the next line and to indent slightly to show that this is a credit entry. Notice that the credit entry is to the right of the debit entry, which is to the left, and this does two things. It keeps us in line with our rule, which debits are to the left and credits are to the right, and it also allows us to see that this entry is indeed supposed to be a credit entry because it's been indented. Again, skip the posting reference column, and we move over to the credit column and enter to the amount of $500 for this particular transaction. So we see here that our transaction includes a debit to cash of $500 and a credit to fees earned for $500. And our rules have been followed in that we have at least 2 accounts that are affected, at least 1 debit and at least 1 credit, and our total debits equal our total credits. And as long as we follow these rules, we'll keep our accounting equation in balance. Now the next question we have to answer is, how do I know which accounts to debit and which ones to credit in order to complete a transaction? Your text provides a step-by-step process to help analyze and record transactions, but here's my thought process on how to record a transaction. The first question I always ask is, does the transaction involve cash? A very high percentage of transactions do involve cash, either getting cash or giving cash. We know that the cash account is an asset account, and we know from the jingle that asset accounts are increased with a debit entry. So anytime we get cash, in other words, some customer pays us money or receive money for rent, or the owner makes a contribution to the business, then the cash fund must be increased, and we do that with a debit entry. On the other hand, anytime the business spends money, writes a check for cash for expenses or some other thing, buying assets, for example, like supplies, then the asset account of cash is being reduced. And if the cash account is increased with a debit, then we know that to decrease it, we were going to have a credit entry. So if cash is involved in a transaction, we can determine one of the accounts and whether it's a debit or a credit by following through with this logic. If cash is involved, then we need to figure out what is the other account that's involved in this transaction. If cash is being received and cash is a debit, then we need a credit. And the options that we have to fulfill this need is either if a revenue was involved, we can credit our revenue account, fees earned, and that makes sense. If we look at our jingle, we see that revenue accounts are increased with credit entries. So that would be one option. Another option would be an asset account that we've sold or gotten rid of. We sold something and we received payment for that. The asset account that we got rid of will be reduced, and we reduce an asset account with a credit entry. Another option there would be if the owner contributed more capital. From our jingle, we see that capital accounts are increased with a credit entry, and that would fulfill our need. And the last possibility would be a liability. If we bought something, an asset, or if we got cash, say as a loan, and made a promise to pay that loan back, then we've increased the liability, increased a promise to pay back in the future, and that would fulfill our credit need in that instance. Now, on the other hand, if cash is being paid and cash is the credit account, we need to know what account we're going to debit. Our possibilities are we could pay off a liability. Liability accounts are increased with credit entries, and they're decreased by debit entries. So we might pay off accounts payable. We would debit the accounts payable account and credit our cash account. Other possibilities are we're paying for expenses. Expense accounts are increased with debits, and we're going to credit cash when we pay cash out. Another option would be the owner would take a draw from the business. We know from our jingle that the drawing account is again increased with a debit entry. The last possibility is that we may be obtaining another asset like supplies or land or equipment and paying cash for that, and so we're crediting cash and debiting some other asset account. Remember, the debit entry always goes on top and is first, and the credit entry follows below and is indented to the right. Now, if cash is not involved, we need to try and identify what account is affected, and then identify the category of the account that's being affected, whether it's an asset, liability, capital, drawing, revenue, or expense, and determine what entry is needed to increase or decrease that account using the little jingle that we know, and then record the transaction by journalizing it. What you have just done is referred to as journalizing. We will be journalizing a lot over the next few weeks, so be sure to review the sample problem that demonstrates how to journalize and see how transactions are journalized, as well as the lecture discussing the general ledger and trial balances. Let me know if there's anything I can do to help. This concludes our discussion on journalizing transactions.